Hello, my dear students. Welcome to my channel. This is Geetha, your CA Foundation September 26 students. Did you attempt this inventory valuation question from MTP series on 20th August 26? If you got stuck in understanding the concept of goods sent on consignment and goods sent on approval basis, I'm going to explain each and every aspect step by step, showing you exactly how you should approach the problem. So take your pen and paper and try the question with me. Let us get into the video. Physical verification of stock in your business was done on 23rd June 2026. The value of the stock they have given, and they have given some transactions took place between 23rd and 30th June 26. I have shown it in the timeline. So the timeline shows that they have taken the valuation of goods. That is physical goods. You should understand this. Physical valuation. Physical valuation means they are counting one by one item and found out the value. Okay. But you are asked to determine the value of stock. Here they did not ask you the physical stock. So there is a difference between physical stock and valuation of stock. Physical stock actually received. But what you do when you receive and when you place an purchase order and invoice raised, what you do it, you will immediately book in the purchases account will get debited and the creditor will get credited. Okay, the vendor will get credited. So all the purchases are included in your accounts book. But when the goods come into the store, we call it as a shop, generally store department where the stocks are getting delivered. Then it may come a little bit later. So there is a difference between physical verification and valuation of stock. So you are given physical verification of stock, but you have to add the stock as per your records, what is maintained in the generally in the accounts department. Okay. So now this valuation of closing stock, that only we are showing in our trading account. How we show it in the trading account to opening stock, then we add the purchases. The purchases are the purchases which you have already ordered and invoiced, not the actual stock which you have received. Okay. So the difference is this one only. So when the purchases are recorded, you are giving in your trading account the total purchases. Okay. On the other side, you are writing the sales. And the difference between the sales and your opening stock and purchases is your closing stock. Okay. So the closing stock is always the in trading account, what you are showing is the value of stock, not the physical stock. You understand the difference between that. Okay. So suppose for example, you are having an opening stock of 10,000 and you have made your purchases of 1,50,000 and this comes to total as 1,60,000. Just for example, I am telling you. 1,60,000 on the debit side of your trading account. And if the material is sold for 3 lakh rupee, and what is this? Your closing stock comes here. Okay, your GP will come here. Okay, after subtracting your GP, your closing stock is taken out here. Done. So now here, what they say that here we are going to take all the adjustments. We are going to add the transaction, effect of the transaction, say that we are going to take in between what happened between 23/6 to 36. Suppose we have purchased something during this, so we have to add it to the opening. This is our opening. Okay, we have to arrive at the closing. Okay, so whatever is in the opening, we are going to add the actual purchases, but not the physical goods, because we are asked to arrive at the closing stock of value. Okay, and everything has to be added in cost, because closing stock is valued at cost or NRV, which already you know. So we are going to add the purchases made during this period, and any sales made we are going to, because the goods has gone out. So we have to subtract it. Okay. The first point we are going to take out of the goods sent on consignment. Now you have to, I'll give a brief introduction about consignment, because if you are not understanding what is consignment, you will not be able to do it. Okay. What is consignment? Consignment means sending the goods to some other person. Suppose one person is in Chennai and selling some goods. Okay. My drawing may not be so good. Please bear with this. So he wanted to sell goods at Kolkata. So now what he will say, he is not going to Calcutta and selling it. He is appointing a person here, asking him to sell the goods in favor of him. He is not selling goods to this person in Kolkata. He is just sending, not selling, sending the goods to this fellow in Kolkata, and he will ask him to sell the goods on behalf of him. And for this service, he will give this person a certain commission. So we are not going into the deep detail of consignment, because it is not in your chapter right now. So the goods are sent on consignment means the goods, once it is sold, okay. If it is not sold, lying here with this fellow, these goods are lying here. These are the goods of this fellow only. Suppose he is A, he is sending goods to B. So the goods lying in the yard of B is A's stock only. Okay, because it is only, this fellow is an agent selling on behalf of him. So whatever the goods lying unsold has to be taken into our stock. But here they have taken the physical stock. Again and again I am stressing on that, because they have counted one by one. So this item was not available in this store department. It was available in Kolkata. So when this was not sold, we have to add it here. Okay. So out of the goods sent on consignment, goods at the cost. So we are going to add everything at cost. Worth rupees 2,40,000 were unsold. So now what we have to do, on the physical value of stock, we have to add 2 lakh 40,000, which was the consignment unsold. Clear? Now coming to the next point. Purchases were made for 4 lakh rupees. During this period, I have already told you, any purchases made, these are all the transactions took place in between 23rd and 30th. So, okay. So, after, from 24 to 30, they have purchased some material for 4 lakh rupees. Means purchase order was made and invoice was raised, and but physical goods have not reached here. No issue. We are going to value the goods only here. Valuation of stock only we are going to take. We are not going to take physical stock. If you are asked to calculate the value of physical stock as of 30th, then we cannot include the goods which are in transit. We have to include only those goods purchased and received. Okay. So here it is not the question. So you have to add this total 4 lakh rupees. But in order to make clear, so that the examiner understands that you understand this concept, you have to write very clearly that purchases made, goods received from 25/6 to 36 is 2,40,000, and the goods not yet received, they are in transit, 1,60,000. So we are going to add that. Clear? So I hope this is clear up to this. Here, I'll take a pause, and I would like to ask all of you that if you are for the first time visiting my channel, watching my videos, please do not forget to subscribe. Okay. So students, the inventory valuation question is a very scoring question and very simple. Once you understand the concept, it is not a difficult one at all. After watching this video, please try it yourself so that you'll be able to find out whether you are able to do it on your own. And watch this video till the end and do not forget to share and subscribe and also comment which part of the video you find more interesting and which was so good to watch. Okay, so please comment on that in case you need further videos like this or any other video on any other chapter till 10 days, 8 or 10 days. 2nd September is your exam, I hope so. So you can comment me on this. Okay, now moving on to the third point. Third point is the very important point. We are going to see this thing. Okay, so now what happens? Goods are sold 13 lakh 60,000. Here I have told you that the goods have gone out. So it is not at all available with us. So we need not to have to add to the valuation of stock. Whatever goods have gone out, cost of goods is sold. We cannot directly subtract the sales because profit margin is included. So minus the profit margin, we have to only subtract the cost of goods sold. COGS. Okay. Cost of goods. We have to subtract the cost of goods sold. Now what they say that in 13 lakh 60,000 the sales made, goods worth 3 lakh 20,000 were sent on approval basis. What is it? It is just like Amazon. You can understand very easily. If you buy a product from Amazon, Amazon is the seller. So he will send the goods to you, but you can return the goods within the time period given. Suppose they have given you 30 days. So what they do, when they send the goods, they take it as sales. Okay, they will be debiting the customer account, customer account, or they would have received money and in advance. Okay, then they will make the sales, but the sale is not confirmed till 30 days. If there is no response till 30 days passed, then they will take it as deemed as sales. Sales is done because the consumer has no right to return it after 30 days. But in case before 30 days is not over and your closing date of accounts has come, closing date has come, then what you have to do, you can't take this as sales of that current year. You have to reverse it. Sales has to be debited to customer. And what you have to do also, you have to take the cost of the goods sold to your closing stock. You have to add that cost of goods sold to closing stock. Clear? Once again, I'll tell you. Once you sell the product, immediately what they do, they'll record the sales. But this sales is not a confirmed sale till 30 days. In case the consumer keeps mum silent, then this is considered as sales and we will proceed. Because the consumer has no right to return it after 30 days. He has to keep it. No way. But in case before 30 days, the due date comes, for example, on 5th May, and we are closing the accounts in 31st March. So the date is still there. So you can't take it as sales because we are closing on 31st March. So what we have to do, we have to reverse the sales. Okay, reverse the sales and the profit is not yet earned. So we have to take the cost of the goods sold to closing stock. That's what here we are going to do with this item. But here one more point is there. This is sent on approval in between 23rd to 30th. Suppose there are so many boxes of goods are there. These total is 48 lakh. Just for understanding purpose, I have made like this. Suppose this box we are selling it, sent on approval. This is of 3,20,000. Okay. These goods were available on 23rd. 23rd it was available in our godown, in our stores department. But on 24th, here, this is 24th, it has gone out. 23rd it was there, 24th it has gone out. Okay. But before 30th, this half of the material was returned and half is still with the customer, for which the due date is not yet come. So whatever is with this fellow is also mine. It is already included here. So that sale we have to reverse back. So it is not a sale. Then that has also come back. Understood? One item physically has come back. Okay. And one item is cancelled because of not the due date over. No information is available. So total 3,20,000 was already available. So we need not to add again to closing stock. Only we have to reverse this entry. Understand? One more time I am telling you that if the material comes back, we have to reverse the sales and add the cost of goods sold to closing stock. But here we have to reverse the sales. No need of adding it because we are having the physical valuation on that date. In this date, it was in this go down only. So still we are taking this as opening stock and calculating. So in this 48 lakh, this value of 3,20,000, the cost of goods, I think 2,56,000, leaving the profit. Profit is of 20%. So that 2,50,000 is already included in this 48 lakh. So there is no need of once subtracting and in the opening subtracting and then again while calculating adding. So no, that will give you a nearly 5 effect. So there is no effect of adding and subtracting. So we can ignore this item. Okay. So that's what done here in 13,60,000. But we have to subtract it from the sales. So what I have done from 13,60,000, because we have to reverse the sales, but need not to add the closing stock because it is already added in the physical stock. Okay. So 3,20,000 you have to subtract. What will be your balance? 11,40,000. And they are saying that there is one abnormal sale. Sale value they have given 1,20,000. So that abnormal sale which is included in 1360, that also we have to remove. So we have to remove first 3,20,000 because it is not a sale. Okay. Then we have to take out the abnormal sale 1,20,000. So we are left out with only 9,20,000. See here it is 13,60,000 is our sales. So 3,20,000 is we are taking it out because it's not a sale. Okay. So left out is your 10,40,000, and in which there is an abnormal sale of 1,20,000. So the normal sale, actually the normal sale, why we take the normal sale? So that we can find out the gross profit. Normal sale is 9,20,000, which was sold at a profit of cost plus 25%. Cost plus 25% means it is 25% on cost. That is, you can take it as 1 by 4 on cost. So what would be on sales? It is 1 by 5 on sales. So you have to subtract the 20%. So when you subtract the 20%, that will come to 1,84,000. When you subtract, it will be, I think, 7 lakh 36,000. This is the cost of goods sold during this period. Plus, this is the normal cost of goods of normal sale. We have got one abnormal sale also. The cost of abnormal sale is 2,40,000. So add that cost of goods sold, that is abnormal sale. They have given the cost as 2,40,000. You add this, you will be getting 9,76,000. Okay, you have to subtract this sale value from this value, because we have added goods sent on consignment, because these goods are our goods. It is not in our store, it is lying somewhere else. And goods purchased during the period is 4 lakh rupee. Some physical goods are received here and some are in transit. So we have given the bifurcation. So the total value of goods 54 lakh 40,000. In that we have to subtract the total cost of goods sold during the period. So it comes to 44 lakh 64,000. This is your answer. ICA must be approaching on the other way, but we approach like this only. You can do like this. Okay. And you have to work out the, give the working note for calculation of normal sale and the calculation of profit on normal sale. So you have to do like this and present your question so that you get the full 10 marks. So you will be easily able to get it. Thank you.